Okay, let's jump in. For this deep dive, we're unpacking the 1929 stock market crash.
And the decade of turmoil that came after.
Right. And our mission here is really to find the specific financial gears that, turned a bad market crash into a total economic catastrophe for a generation.
What's so striking in the sources is the setup. The Roaring Twenties, I mean, it was an era of just explosive confidence.
You had all this new tech radio, mass-produced cars, electricity in homes.
Exactly. And that excitement, that feeling that things could only go up, it bled straight into the stock market.
Which, as we know, allowed the financial foundation underneath it all to get incredibly fragile.
You could even say it was rotting from the inside out.
And the absolute core of that rot was leverage, specifically margin debt. So can you unpack that for us? How does a rule letting you buy stocks with just 10% down become, well, the market's fatal flaw?
Right. Well, just think about it. You only needed $10 to control $100 worth of stock.
That's incredible.
It is. And a tiny price jump, say 10%, meant you doubled your money instantly. But the flip side was lethal. A 10% drop and you were completely wiped out.
Your entire investment just gone.
Gone. And because nearly everyone was doing it, the whole system became this interconnected house of cards.
Which brings us to that famous anecdote, the Joe Kennedy shoeshine boy story.
Ah, yes. The ultimate symbol that the top was in.
He knew it was time to sell when even the boy shining his shoes was giving him stark tips.
He figured if the maybe had reached that level, a crash wasn't just likely, it was inevitable. That story just captures the exact moment the smart money started getting nervous.
And once that confidence evaporates, the mechanics of the market turn vicious. The sources say it started to wobble in September.
But the real earthquake was Black Tuesday, October 29th, 1929.
Panic selling starts. But those thin 10% margins, they took a bad situation and just poured gasoline on it.
It was the forced liquidation that really broke the market's back.
So people weren't even deciding to sell anymore, were they?
Not at all. They had no choice. The banks were making margin calls, demanding their loan money back immediately.
And if you couldn't pay, you had to sell, no matter the price.
Precisely. You had this torrent of forced selling. And on the other side, there were literally no buyers. Stocks of huge, solid companies were dropping 30–40% in a matter of hours.
So the crash wasn't just about speculators losing their shirts. The real story, the one that led to the Great Depression, was the chain reaction.
Yes. This is the crucial connection.
It hits the banking system. Walk us through that. What happened to the regular person who never even owned a single share of stock?
This is the most painful part. The banks had loaned all this money to the speculators.
Who now couldn't pay it back.
Exactly. So the speculators defaulted, and that caused the banks themselves to collapse. They just went under.
And back then, there was no FDIC, no deposit insurance.
None. So if your local bank failed, your life savings, the cash you thought was safe, was just gone, wiped out overnight.
That's terrifying. It wasn't just a failure of Wall Street then. It was a complete demolition of Main Street's trust in the entire system.
And that's what spiraled into the Great Depression. That's how you get to 25% national unemployment.
So this realization that the whole structure was flawed, that's what finally spurred the government to act.
It had to. The scale of the failure was just. It was unprecedented. They created the Securities and Exchange Commission, the SEC.
The new sheriff in town?
Right. A watchdog with a simple mandate. Make sure this can never, ever happen again.
And their first order of business was that leverage problem.
Absolutely. They raised that margin requirement from a dangerous 10% all the way up to 50%. You couldn't build a fortune on a shoestring budget anymore.
But it wasn't just about leverage, was it?
No, they also tackled transparency and fairness. Companies were now forced to publish honest financial reports.
No more cooking the books.
And crucially, insider trading, that shady practice of using secret knowledge for profit, was finally made illegal.
So if we step back, the single biggest lesson from all this is how a mechanism designed for speed, that 10% margin, was the exact vulnerability that brought the whole system down.
It's just a powerful reminder of how a few, seemingly small rules about risk can lead to absolute macroeconomic catastrophe.
And for you listening, think about this for a moment. That single change, raising the margin requirement from 10% to 50%, it didn't just add stability, it fundamentally altered who could afford to meaningfully participate in the stock market. So did that rule, designed to protect the system, unintentionally create a new kind of financial gatekeeping, making the market an arena mostly for those who are already wealthy.
We're diving deep into the sources covering the 2008 Great Financial Crisis. And our mission today is to really simplify the part of this that still feels so confusing.
It's a key distinction the sources make. See, earlier crashes were often about simple greed, but 2008, this was about complex math.
Right. And that math, as our sources put it, basically created a financial bomb. A bomb built by some of the smartest people on Wall Street.
Exactly. I mean, it was so opaque that even the CEOs running the banks didn't seem to fully grasp the risk they were holding. Complexity was the perfect place to hide.
So let's start at the very beginning, the foundation of all this risk. The subprime mortgage. What made these so different?
Well, the underwriting standards just collapsed. Banks started giving out loans to practically anyone. You had the now infamous any Enja loans.
No income, no job or assets. I mean, what was the thinking there? Why take on that kind of, well, unbelievable risk?
It was one single flawed idea that drove the entire system.
Let me guess. The belief that house prices only go up.
You got it. The thinking was, if the borrower defaults, who cares? The bank just takes the house, sells it for more, and still makes a profit. It seemed foolproof.
But, okay, even with that assumption, the banks didn't want to hold all of that raw, unstable risk themselves. So what did they do?
Securitization. This is the first big step where the risk gets hidden. They took thousands of these really risky mortgages.
And just bundled them all together?
Yep, all together into one investment product, a mortgage-backed security or MBS. They just mixed the good, the bad, and the truly awful all into one pot.
Wait a second. So they take this fundamentally volatile product, bundle it, and then try to sell it as safe. How do you convince, say, a pension fund to buy that?
That's the million-dollar question, isn't it? And the answer is pretty shocking.
Okay.
They paid huge fees to the rating agencies Moody's, S&P to stamp these things, AAA.
Wow, a AAA rating. That's supposed to be as safe as a government bond.
It's supposed to be, and it worked. It completely hid the toxic ingredients inside. But, it gets even crazier.
How could it get crazier?
Well, Wall Street looked at the worst parts, the absolute junk left over from creating these MBS, and they decided to repackage it. Again.
You're kidding me.
That's the collateralized debt obligation, the CDO. This is where the complexity just becomes catastrophic.
I've heard this explained with a pretty vivid analogy. It's like taking old fish, grinding it up, and calling it gourmet seafood stew.
That's a perfect way to put it. And financially, the trick was slicing this recycled debt into different risk levels called tranches. It allowed them to multiply their bets on this stuff far beyond its real value.
And then, inevitably, the music stopped.
It did. In 2007, housing prices didn't just stop rising, they started to fall. Defaults just exploded.
And those AAA stamps suddenly meant nothing.
Absolutely nothing. The bonds became worthless, just toxic waste on bank balance sheets. And then came September 15th, 2008. Lehman Brothers goes bankrupt.
And the whole system freezes.
Yeah. It froze solid. But not just from the losses, it was the opacity. Because everything had been sliced and diced and repackaged so many times, no bank knew who was holding the poison. Lending just stopped overnight.
Which connects to those few outsiders, right? People like Michael Burry, who somehow saw this whole thing coming.
Yeah.
What did they understand that no one else did?
I mean, it's almost funny how simple it was. They just read the documents.
They actually read them.
They did. And they saw that the whole system was built on this idea that a housing bust in, say, Florida wouldn't affect a boom in California. They saw that the risk was all connected. When the national market turned, the whole thing would go down at once.
The entire house of cards.
The entire house of cards. They saw the correlation risk that the complex math was designed to hide.
So the core lesson here, for you listening, is that 2008 proved that financial complexity is the perfect camouflage for catastrophic risk.
Right. It allows risk to be hidden, packaged, and spread around the world until the whole system just seizes up.
So that leaves us with a final thought for you to explore. If sophisticated instruments are being created today that are too complex for even regulators to fully understand, what is the modern equivalent of that hidden toxic waste lurking in the system right now? And what steps should you take to identify where complexity might be hiding risk today? Welcome to the deep dive. We've gone through the sources you sent over and pulled out the absolute key insights. Today we're tackling a big one. Who actually controls the U.S. money supply? I mean, who has their hands on the lever?
Right. It's a common misconception. You'd think it's the president or maybe Congress.
But it's not. The sources make it really clear. The real power lies with an independent, totally unelected group.
Just 12 people.
Exactly. 12 governors. We all know them as the Federal Reserve. Or just the Fed.
And our mission for this deep dive is to get past the headlines and really understand what they do. What are their specific jobs? And more importantly, what's the one huge tool they use to basically steer the entire economy? It all starts with something Congress gave them called the dual mandate.
Two jobs.
Two very specific jobs. First, maximum employment. The goal is basically everyone who wants a job can get one.
Okay, that makes sense.
Second job, stable prices. In practice, that means keeping inflation really low. They're always targeting about 2%.
And the sources really hammered this home. This isn't just two goals. It's a built-in conflict.
It's a fundamental tension.
Because if you have really high employment, everyone's got a job, wages start going up.
And that often leads to high inflation. The economy starts to, overheat.
So the Fed is constantly trying to balance these two things that, well, they pull in opposite directions.
Exactly.
So how do they do it?
Yeah.
How do 12 people manage this incredible balancing act?
They have one primary lever, one main tool.
The federal funds rate.
That's it. It's all about interest rates. And it's fascinating because it's not the rate you or I pay directly.
Right. It's the rate banks charge each other for what, overnight loans?
Exactly. But by controlling that one single rate, they effectively set the price of money for the entire country.
The sources used a great analogy for this. They said to think of it like a set of pedals, a gas pedal and a brake.
Perfect analogy. When the economy is stalling out, heading for a recession, they hit the gas.
By lowering rates.
They push rates way down, sometimes towards zero, and suddenly money is incredibly cheap.
So businesses can borrow to expand, people can afford mortgages.
And the stock market goes wild. It just loves cheap money.
Okay, so that's the gas. What about the brake?
The brake is for when inflation is too high, the economy is overheating.
So
They slam the brake pedal, they raise rates.
which makes borrowing expensive.
Very expensive.
Yeah.
Businesses stop hiring, people stop buying houses, and the stock market, it usually goes down hard.
Which leads us directly to what the sources call the golden rule of macro investing.
Don't fight the Fed.
It sounds so simple.
It is, but it's everything. If the Fed is cutting rates, printing money, you have to buy stocks.
Because the money is basically free.
Right. Even not so great companies get lifted up. But the second they start raising rates or sucking money out,
You sell.
you sell your risky assets. Money is tight now. Debt is expensive. The entire game changes.
And to really understand just how much power this gives them, we have to talk about the Paul Volcker example.
Oh, yeah. The ultimate stress test. We're talking 1980.
Inflation wasn't just high, it was completely out of control. It hit, what was it, 14%?
A devastating 14%. And Volcker, the Fed chair, he made a decision that was just, politically insane.
He raised the Fed funds rate to an unheard of level.
20%.
20%, I can't even imagine that.
No. And he did it on purpose. He intentionally crashed the economy. Unemployment went through the roof.
But it worked.
It worked. It was brutal. But he killed inflation. He stabilized the dollar. And he set the stage for the huge boom we saw in the 90s.
It's that classic idea, right? Sometimes the doctor has to cause some serious pain to cure the disease.
That's the perfect way to put it.
So, wrapping this all up, the key insight here is the incredible power that these 12 unelected people have
With a single lever.
to speed up or slow down the entire economy.
And that Volcker story, it forces us to confront a really difficult question. We know their goal is that 2% inflation target.
Right.
But if achieving that target requires them to deliberately cause economic pain, like massive unemployment,
Yeah.
the question we want to leave you with is this. How much pain is an acceptable price to pay for price stability?
Where do you draw that line? That's something for you to think about.
Welcome to the deep dive. Today we're digging into inflation versus deflation. Our goal is pretty simple. Figure out why falling prices, which sound amazing for your wallet, are basically an economist's worst nightmare.
Exactly. We're talking about two sides of the same coin. Inflation is, when your money buys less over time. Some people call it the invisible thief.
The invisible thief, I like that. And deflation.
That's the opposite. Your money actually buys more. And that sounds great, right? But the behavior it creates can be, catastrophic for an economy.
Okay, let's start there. Why would the government actively want prices to rise, even by a little bit? Like that 2% target we always hear about. It feels so backwards.
It's all about psychology and getting you to act. If you expect that new TV is going to be 2% more expensive next year, what do?
You buy it today.
You buy it today. And that purchase drives the whole economy, demand, jobs, everything, keeps the wheels turning.
So it's a nudge to prevent stagnation, but that's not the only reason, is it? I've read about the debt angle.
Oh, the debt angle is maybe even bigger. Inflation is a huge help to anyone who owes money. Think about a big mortgage, say $300,000.
Okay.
If the dollars you're paying it back with are worth less each year because of inflation, the real weight of that debt is actually shrinking.
So your debt gets easier to pay off over time. And when we think about who the biggest debtor in the world is,
It's the U.S. government. By a long shot, they have a massive incentive to have a little bit of inflation to erode the value of their own debt.
Yeah.
That 2% target suddenly makes a lot of sense.
right, it's a feature, not a bug, for their balance sheet. So let's flip this. Let's talk about the horror of deflation. If prices are falling, why is that so dangerous?
It's that same psychological trigger, but in reverse. If you know that car will be 10% cheaper next year, you wait.
Of course. And if everyone waits.
Then nobody buys anything.
Okay.
And that's the start of the deflationary spiral.
Explain that. What's the chain reaction?
Well, if demand vanishes, companies stop making things. They fire workers. Those unemployed workers, they can't buy anything. So demand falls even more, prices drop further, and it just feeds on itself. It's a vortex.
And historically, this isn't just a theory.
No, this is the Great Depression. That's what happened. And once that spiral starts, it is incredibly hard to stop.
Okay, so this is getting very practical. For you listening, how do you hedge against these two outcomes? What do you do if you expect high inflation?
For inflation, you want to own real things, real assets, property, commodities, or equities, stocks. Companies can raise their prices to keep up with inflation, so they offer protection. The last thing you want is cash or a long-term bond.
And if we're heading into that deflationary nightmare,
Everything flips. Cash is king. Every dollar you're holding is literally gaining purchasing power. You can buy more tomorrow with the same dollar you have today. Long-term government bonds also become really attractive.
we've covered bad and worse. But there's an extreme out there, isn't there? Hyperinflation.
Yes. Hyperinflation is what happens when a country just loses all faith in its currency. A government tries to print money to pay its bills with no real production to back it up. The most famous example is probably the $100 trillion bill from Zimbabwe, a piece of paper that was essentially worthless. History is just littered with dead currencies.
So the big takeaway here is that our economic health depends on walking this incredibly fine line. We need a little bit of price increase to keep things moving and to manage all this debt.
It's a tightrope walk, for sure, which leaves you with a really important final thought to consider. Given that the U.S. government is the world's largest debtor, and it clearly benefits from a bit of inflation, what do you think the odds are that they would ever truly want to eliminate inflation completely? Whose interest does that 2% target really serve?
Welcome to the deep dive. Today, our whole mission is to give you a kind of structural roadmap for the economy.
Right.
Because for an investor, knowing how to rotate your portfolio shouldn't be guesswork. It's really just about knowing what season you're in.
Exactly. It's scaffolding. If you get these 4 phases, you get a massive advantage. You can stop, reacting to every market swing and just run the playbook.
Okay, let's start with phase 1, early cycle, the recovery. The vibe here is, well, it's pretty rough.
Oh, it's terrible. Sentiment is in the gutter. But the key sign, the structural one, is that the Fed has started aggressively cutting rates.
Trying to jumpstart the engine?
Precisely. So this is the time to take on risk, to bet on that snapback. Your strategy is just aggressive growth.
So where do you put your money?
You're all in on interest-sensitive sectors. Think financials, so banks, real estate, and consumer discretionary.
Right, things people stopped buying, cars, fancy watches, that kind of stuff.
Exactly. That pent-up demand is about to be unleashed.
So once that demand is out, we move into the next phase, the mid-cycle or expansion.
This is the good part, yeah.
This is the Goldilocks zone. Growth is strong, it's steady, everyone's feeling good.
And the strategy shifts.
It does. Now companies are confident, so they're spending. Big time. On new factories, new software.
So you follow the money.
You follow the money, you pivot to industrials, and of course, technology. The goal here is just pure momentum. You ride the wave.
Okay, so if phase 2 is the party, phase 3, the late cycle, that's when things start getting a little messy.
That's when the music gets too loud. You start seeing real inflation. The big tell is the cost of labor. Wages start shooting up because everyone's hiring.
And the Fed sees this?
The Fed sees this, and they have to tap the brakes hard. They start raising rates.
So what works when inflation is the big story?
Well, you can't hide from it. You have to embrace it. You look for shelter in hard assets.
So we're talking materials. Think mining companies. And energy. This is their moment. And strategically, the party's winding down. You need to start taking profits off the table.
Which brings us to the inevitable final phase. Recession, contraction. The vibe is panic.
Total panic. GDP is negative. Everyone's retreating.
So how do you play defense?
You have to ask, what do people buy no matter what? When money gets tight, you might cancel a vacation, but you don't stop brushing your teeth.
Right.
So you rotate into the essentials. Utilities people keep the lights on, healthcare, and consumer staples.
Toothpaste and diapers.
Literally toothpaste and diapers. The playbook is pure defense.
Yeah.
Call it rotation into safety.
Okay, we've got the 4 seasons, but how do we predict the weather? The sources all pointed to one thing, the yield curve inversion.
This is the detail you absolutely need to remember. Normally, you demand higher interest for locking up your money for a longer time. A 10-year bond pays more than a 6-month bill.
Sure, that's just common sense.
An inversion is when that flips on its head. When short-term rates suddenly jump higher than long-term rates.
Wait, hold on. Why would anyone accept less money to lock it up for 10 years? What is the bond market seeing that nobody else is?
They're seeing a crash coming. The bond market is basically screaming, the Fed is hiking too fast, they're going to break something and cause a recession, and we know they'll have to slash rates in the future to fix it.
So they're pricing in the future rate cuts.
They're pricing in the panic. It's a massive warning sign.
So understanding that cycle, that structure, it gives you a framework for everything. You're not guessing. You're just shifting your strategy with the seasons.
And here's the final thought to leave you with. That yield curve inversion. It has an absolutely astonishing track record.
Better than the experts.
It has predicted recessions more accurately than any single economist out there. When the bond market speaks, you really ought to listen. So when you think about the stock market, I think a lot of people still have this picture in their head. You know, a noisy room, traders in suspenders shouting.
Oh, yeah, the classic buy-sell image from the movies.
Yeah.
That chaotic trading floor.
Exactly. But that picture is, well, it's about 40 years out of date. The reality today is so different.
Completely. I mean, something like 80% of all trading volume now is driven by algorithms, not people.
And that's what we're diving into today. This world where humans, sure, they set the strategy, but it's robots that actually pull the trigger.
Specifically, high-frequency trading systems, or HFT. And our mission here is really to unpack how this whole thing works, because it's all about pure, unbelievable speed.
And speed is really the key word. When we say high frequency, we're talking about transactions happening in, what is it, microseconds.
Microseconds, a millionth of a second. It's almost impossible to really wrap your head around.
And at that speed, you're not thinking about a company's value or its earnings reports. HFT firms care about one thing, and basically one thing only.
That's right. It's called order flow.
Right. Order flow.
And that's just, seeing where the big money is moving, tracking the huge pension funds, the mutual funds, and anticipating their next move before it even happens.
So if you can see a giant buy order for Apple stock is coming, you can get in front of it.
Get in front of it. That's the entire game. It's why they engage in this practice that's
Well, it's very similar to front run.
illegal. Right, but this is sort of a legal-ish version. They're not acting on a client's order after they get it. They're just predicting market movements milliseconds before they hit.
So let's use that Apple example. The HFT computer sees this massive pension fund ordered to buy millions of shares. It then races ahead, buys up a ton of Apple stock itself, and then a split second later sells it right back to that same pension fund.
For just a penny or two higher, that's all.
A penny seems like nothing to a huge fund.
It is nothing, but the HFT system does this billions of times a day. And those tiny fractions of a penny suddenly become astronomical profits.
And to make sure they always have that speed advantage, they have this physical arms race. It's called co-location.
Yes. This is where it gets really wild. These firms pay millions of dollars a year just to place their computer servers inside the same data center as the stock exchange's servers.
Because being 10 feet closer physically actually makes your signal arrive faster.
It sounds absurd, but that's the level of competition. That proximity, that tiny time advantage is worth millions.
And that's a downside. I mean, optimizing for speed like this has to create some kind of fragility in the system.
Oh, it does. A devastating fragility. And we saw it firsthand on May 6, 2010, the flash crash.
Right. I remember watching that happen. At around 2:30 in the afternoon,
Yeah.
the Dow just It fell off a cliff.
It plunged 9% in just a few minutes. I mean, blue chip stocks, huge, stable companies like Procter & Gamble, their stock went from $60 to just pennies.
And then it bounced right back.
Yeah.
But for those few minutes, it was absolute chaos.
It was. And the cause was the speed itself. A single large sell order started a digital domino effect.
So all the HFT algorithms saw the price dropping.
And they're all programmed with the same logic. If prices drop, sell immediately to limit your losses. So they all started selling to each other, creating this death spiral.
And the liquidity, the ability to find a buyer, it just disappeared.
It vanished. It was an illusion.
The key takeaway for you, for anyone watching the market, is that in a digital world, liquidity can disappear the second the algorithms decide to just turn off.
So we've moved from a market of human judgment to one of pure speed and risk.
Exactly. But there's one final really strange anecdote from that 2010 crash that we have to talk about.
Ah, yes. The story of Navinder Sarao.
The spoofing bandit. This story is just incredible. Sarao was a trader operating from his parents' basement in a suburb of London.
On a computer he built himself.
And he created an algorithm to essentially fake out all these super powerful, multi-million-dollar HFT bots.
He was spoofing, faking huge sell orders to trick them. Right. He'd place massive orders he had no intention of filling, which would spook the algorithms into panic selling, and he may have actually helped cause the flash crash itself.
So it leaves you with a really unsettling question, doesn't it? What does it mean when one person, trading from their bedroom, can manipulate a system powered by these incredibly expensive co-located supercomputers?
It means the system is faster than ever. But maybe, just maybe, it's also more vulnerable than we've ever realized. Something for you to think about. Welcome back to The Deep Dive. Today, we're getting into something pretty fundamental. We're looking at decentralized finance, or DeFi.
Right. And the mission today is to unpack this core idea. Could you actually replace a bank and all the trust that goes with it entirely with code?
It's a huge question, and our sources really frame it as a battle of ideas computer science versus traditional monetary policy.
Exactly.
So let's start at the beginning with the original disruptor, Bitcoin. It's often called digital gold, which sounds great, but what does that actually mean for you?
Well, the thing to really grasp is its scarcity. Our source material really hammers this point home. There will only ever be 21 million Bitcoins.
Okay.
Ever. Now, that's not a policy that can be changed by a central bank or a government. It's written in the code. That's the insurance policy idea.
So that immutability is key. But then you hear these stories about people losing all their Bitcoin. If the network is so secure, I mean, it's never been hacked, right? So where's the weak link?
That is such a critical distinction. The Bitcoin network itself, it's probably the most secure computer network on the planet. The vulnerability has always been the centralized places holding the Bitcoin.
The exchange?
The exchanges. Exactly. You still have to trust a third party to hold your assets, even if the asset itself is trustless.
Okay, so if Bitcoin is the secure ledger, the digital gold, Ethereum is where you actually build the anti-bank. The sources call it the world computer. How do we get from a store of value to that?
We get there through something called smart contracts.
Right.
And don't just think of them as a simple if this, then that command. It's more like, it's like a fully autonomous escrow account that lives on the blockchain. It executes the terms of an agreement automatically.
So no lawyers, no bankers, no human intervention needed.
None. The code is the law. The code is the final arbiter. And that's what opens the door to all these DeFi applications: lending, borrowing, trading.
And the key thing here is that they're non-custodial, right? The code manages the transaction, but you never hand over your assets to someone else.
Precisely. You always maintain control. The protocol just locks it as collateral. That's what eliminates the counterparty risk. That is a truly trustless system.
But this is where it gets a little dicey because our sources are very clear. This space is the Wild West. So let's talk about the risks.
Okay, number one is always volatility. I mean, you have to be prepared for what they call a crypto winter. We're talking potential 80% drops in value. It is not for the faint of heart.
And then there are the straight-up scams. We've all heard the term rug pull.
And it's not just a theoretical risk. One source pointed out that in 2021 alone, investors lost something like $7 billion to these schemes. Developers hype a project, get people to invest.
And then they just disappear with the money.
They drain the funds and vanish.
So finally, there's the big systemic threat, regulation. If this whole system is built to be uncensorable, how do governments try to regain control?
They go for the choke points. They go for the
The
on-ramps.
exchanges again, where real money turns into crypto.
Exactly. Those exchanges are centralized companies. They have to
Yeah.
follow regulations so governments can pressure them, even threaten to ban them, and cut off the flow of fiat money into the whole ecosystem.
So you have this constant tension, right? This trustless code on one side and this desire for centralized control on the other.
And that leads to this final, really fascinating thought for you to consider, a paradox at the heart of it all that the sources call the oracle problem.
The Oracle problem.
So
Okay.
smart contracts are genius because they're isolated on the blockchain. They can't be tampered with. But that also means they're blind. They can't see what's happening in the real world.
Right. Okay. So say you make a bet on the Super Bowl with a smart contract. How does the blockchain, which is just a digital ledger, know who actually won the game?
It can't.
Yeah.
Not on its own. It needs an external data feed, an oracle, to tell it the result. Something like the Chainlink network. And that oracle has to be trusted to provide accurate data.
Ah, so you're reintroducing an element of trust.
You're reintroducing a weak link. In a system designed to be completely trustless, you find that at some point, it still needs to trust a validated signal from the outside world. And that's the paradox for you to think about. How decentralized can the system truly be? All right, so for a while now, we've spent our deep dives on the how. You know, the math, compounding, all of that.
The mechanics of it, yeah.
Exactly, the mechanics. But today, I think we really need to dig into the why. Because financial success, it's not really about the spreadsheet, is it? It's about the psychology of satisfaction.
It's so critical. And, history is just littered with examples that prove this point. I mean, think about a guy like Jesse Livermore.
The legendary trader.
Right, absolutely brilliant. Understood the market inside and out, but he died miserable. So just knowing the numbers clearly isn't enough.
So that's our mission for this deep dive. Let's use the research, let's use the stories, and really try to pin down the difference between just being rich and being truly wealthy.
And what enough actually means.
Yes, and what enough really means to you. Okay, so let's start with the big trap that the sources all point to. They call it the hedonic treadmill.
Mm-hmm.
It's this idea, this really common belief, that if you just hit a certain number, I don't know, say $1 million, then boom, permanent happiness.
And it's not true. The science on this is pretty clear. You get a happiness boost for sure, but it wears off. And fast.
How fast are we talking?
Our sources peg that initial spike at about 3 months. Humans just adapt so quickly to luxury.
It's like buying a huge new TV. For a month, it's amazing.
And then it's just the TV. And worse, you see your neighbor's even bigger one, and suddenly you feel poor again.
Right. And the cruel twist here is that the stress of maintaining that lifestyle, that often stays. The happiness fades, but the car payment, the bigger mortgage,
Yeah,
that doesn't.
that sticks around.
So if that's the trap, how do we get off the treadmill? The sources draw a really sharp line here, a distinction between two ideas, being rich and being wealthy.
They're not the same thing at all.
Not at all. Rich is high income, but it's also a high burn rate. You know, the person driving the Ferrari who, if their job stopped tomorrow.
They'd be broke in a few months.
Yeah.
Exactly. That's the burn rate.
Well,
Wealth, on the other hand, it's different. It's owning assets. Assets that buy you your freedom. That person might be driving a Toyota, but they own their time.
so the goal isn't the yacht.
The goal is not the yacht. The real goal is autonomy. It's the ability to wake up in the morning and say, I can do whatever I want today.
This brings us to a really powerful insight from Morgan Housel.
Hmm.
He just nails it. He says, wealth is what you don't see.
Yeah, and what he means by that is it's all the things you don't buy. It's the first-class upgrade you skip, the designer watch you don't purchase.
The diamond's not bought.
Exactly. It's the money that stays in your account, quietly compounding. That's the stuff that lets you sleep at night. That is true wealth.
And there's this incredible true story that just perfectly illustrates this. The janitor and the executive.
Oh, it's one of my favorites, Ronald Reed.
Yeah, a janitor from Vermont. And all he did was buy blue chip stocks and just held them for decades.
Then when he passed away, he had, what was it, $8 million?
$8 million. And you contrast that with these high-flying Wall Street executives who were making millions a year but went completely broke in 2008.
Because they were chasing status. They were playing the rich game, not the wealthy game.
The janitor won. He won the long game because he was patient and this is the key, he knew what enough was for him, a concept they never grasped.
So to kind of wrap this all up, true wealth isn't just a number in an account. It's It's control. It's the autonomy you buy with the money you don't spend.
Which all comes back to defining enough.
It all comes back to defining your personal level of enough.
Okay, so we'll leave you with this to think about. If real financial success is about knowing your enough number, what would happen if you actually sat down and defined that number right now? How would that change the decisions you make with your money, I don't know, even just this week?
Welcome to the Deep Dive. Today, we're digging into the core lessons from what amounts to a Bachelor of Science in Financial Markets. Our whole mission here is to shortcut that journey. We want to transform the question from, how do I buy a stock to how do I actually build a legacy?
And it's amazing how fast the source material gets right to the point.
Yeah.
That first lesson, FIN 101, it sets up this crucial idea that the market has two personalities.
Right, this voting machine versus weighing machine idea.
Exactly. In the short run, it's a popularity contest, a voting machine. But long term, it's a weighing machine. It only cares about real underlying value. And that forces you to think about risk and reward not as some vague concept, but as something you can actually measure.
Okay, so if we're going to measure value, we need to speak the language of business, which is, of course, accounting. I love the guiding principle here. Price is what you pay, value is what you get.
Yes. And the price can be a complete distraction or even a lie.
So you need a truth detector.
You absolutely do. The sources really hammer this point. Ignore the income statement at first anyway. It's too easy to manipulate with, non-cash stuff like depreciation.
So where's the truth?
It's in the cash flow statement. That's where you see the real cash coming in and going out.
Yeah.
It is incredibly hard to fake. I mean, the sources basically warn that a cheap stock is often just a company that's drowning in debt.
Okay, so the cash flow statement is our lie detector for a single company. But how do we scale that up? How do we build a defense for the whole portfolio against, the whole economy?
That's the next big step into portfolio strategy. And the lesson is stark. One stock is a gamble. A portfolio is your safety net.
And the magic ingredient is this idea of uncorrelated assets.
That's the whole game. You're looking for ingredients, stocks, bonds, real estate, gold, that don't all go up or down at the same time. So when stocks get hammered by bad economic news, your bonds might be holding steady or even going up. They act as a buffer.
But this requires a lot of discipline, right? This concept of rebalancing. It seems so counterintuitive. You're forced to sell your winners to buy your losers.
It does. It feels weird, but it's the most essential non-emotional discipline you can have. It systematically forces you to sell high and buy low. It takes your own worst instincts, like chasing momentum, out of the equation.
And chasing momentum is what gets you killed when you get to the really advanced stuff.
Yeah.
I mean, let's talk about derivatives. The sources are pretty clear that leverage is a double-edged sword.
Oh, it absolutely is. It's terrifying if you misuse it. But for a disciplined investor, these tools should be used for one thing and one thing only.
And that is?
Insurance. Hedging. You don't buy fire insurance because you want your house to burn down. You buy it to protect the asset you've already built. A protective put, for instance, isn't a bet. It's a shield against those sudden catastrophic events, the black swans that no one sees coming.
And then zooming all the way out, the final 30,000-foot view, the big one. Don't fight the Fed.
Yes, this is the macro environment you're swimming in. Interest rates and inflation control everything. When the Fed raises rates, they are fundamentally changing the math for every company's future earnings.
So all those high-growth stocks immediately get less valuable.
Instantly. You're just a passenger on the ship of monetary policy. You have to know which way it's sailing.
When you connect all these dots, from the cash flow statement all the way to the Fed, the biggest takeaway isn't technical at all, is it? It's psychological.
It's entirely psychological. That's the ultimate realization. Wealth is psychological. It's not the number on your screen. It's the ability to sleep soundly at night. It's owning your time. That's the real end goal.
So the degree might be finished, but the learning never, ever stops. The market will always find a way to humble you. And since the sources all agree that the market will always surprise you, let's leave you with a final thought. Beyond the Fed and beyond black swans, we try to insure against. What unexpected, maybe unquantifiable sociopolitical factor do you think will define the next chapter of our financial journey?
All right, welcome to the deep dive. So we've got a classic today, the Investor's Manifesto. And you basically asked us for the cheat sheet. You want the core, non-negotiable wisdom for, actually surviving decades in the market.
And that's the mission. We're extracting the foundational discipline because, the author argues that success isn't really about being smart. It's about not sabotaging yourself. We have to focus on the systems that defeat our own human nature.
Okay, so let's unpack that. Let's start with the mechanical side of it. The law of time. Compound interest is famously called the eighth wonder of the world. The real nugget here is that time doesn't just add returns, it multiplies them exponentially.
Exactly. And that advantage, that time advantage, is what makes the law of costs so critical.
Right.
The source uses this great analogy. Fees are termites.
Mhm.
I mean, think about it like this. A seemingly tiny 2% annual fee.
Seems like nothing.
Right, but over 30 years, it doesn't just shave off 2%. It will consume a staggering 40% of your total wealth.
1%, just gone to termites.
Gone. Which means fighting for those low-cost index funds and ETFs isn't just a preference, it's a high-stakes battle to preserve that power of compounding.
Okay, so understanding time and cost is
Yeah.
the easy part. It's just math. The
Right.
real failure point is, well, us, the operator.
It's always us. That brings us right to the psychology, the law of emotions. You are the biggest risk in your own portfolio. It's always that push and pull between greed buying high and then total fear selling low.
But systems are so easy to abandon when the market is crashing. I mean, how do you actually build a defense against that panic?
You build compulsory automation. That's why the source pushes so hard for things like dollar cost averaging or DCA.
Investing a fixed amount regularly.
Exactly. That systematic, unemotional process forces you to buy more when things are cheap, and it stops you from chasing the peaks. Discipline, it beats genius every time.
And that connects to the law of safety, right?
Perfectly. Diversification is called the only free lunch in finance because you're fighting the fact that the future is it's a distribution of probabilities. You can't know for sure.
That makes sense. Systems to manage your behavior. Okay, let's shift focus to what we actually buy. The law of value. It tells us to stop confusing the ticker symbol with the underlying business.
That's the whole thing. A stock is a piece of a company. You have to focus on what matters, the actual cash flow, the earnings, not the market's hype. Because history proves that hype always leads you to the law of gravity.
Reversion to the mean.
Yes, and I love that phrase from the book.
Trees do not grow to the sky.
It's unforgettable for a reason. When an asset class goes parabolic, when everyone is suddenly an expert on it,
Oh.
that's usually the signal. It means the price has completely decoupled from reality, and gravity must eventually pull it back to its intrinsic value.
That's a vital reality check. Okay, so let's cover the practical warnings. First, the law of skepticism.
Yeah, this one is simple. There is no such thing as high return with low risk.
If it sounds too good to be true.
It is fraud, plain and simple. It's not an opportunity, it's a trap.
And that usually goes hand in hand with the law of simplicity.
It does. If an investment is so complex you can't easily explain it to a teenager, it is probably designed to enrich the seller, not you. The data shows simple portfolios, just stocks and bonds, almost always outperform complex strategies over time.
So if we boil this all down, what it means for you is that success in investing it's less about market calls and more about patience, low costs, and emotional discipline.
And skepticism. Exactly. Which means you have to define the finish line. The final, most profound rule is the law of enough.
The law of enough.
Yeah. If you don't define a finish line, you will run the race forever, just chasing a meaningless number that keeps getting higher. The goal isn't the highest possible number. The goal is your freedom.
You need to define enough. So based on these immutable laws of patience and discipline, here's the thought to leave you with. What specific number or what state of being defines rich for you? That's the critical decision these laws force you to make. If you've ever taken a basic finance class, you've had one rule drilled into your head. It's the one that governs, well, everything.
Higher risk equals higher reward.
Exactly. If you want a higher reward, you have to take a higher risk. That's the deal.
Huh.
But here's where it gets really interesting, because today we're diving into a paradox.
Some people call it the free lunch of modern investing.
The free lunch, right. And what's so fascinating is that while that rule is true for, any single asset, it has this huge multi-billion-dollar loophole when you start combining them.
And that discovery changed everything. It completely altered how professional money managers and big institutions handle their portfolios.
And the person who blew up that old model was Harry Markowitz. And you have to picture this. It's 1952. He's a 25-year-old grad student.
It's just a kid, really.
And he submits this paper that essentially proves that basic risk-reward equation isn't some unbendable law of the universe. His work became the very bedrock of what we now call modern portfolio theory.
MPT. And it won him a Nobel Prize for it decades later.
As it should have.
Well, the core insight of MPT is it's genuinely revolutionary. You can take a bunch of risky assets, combine them in a very specific way, and the portfolio that comes out the other side actually has less overall risk.
Without just tanking your return.
Exactly. Without necessarily sacrificing your expected return. That's the optimization. So our mission today is to unpack the tool used to visualize all this, the efficient frontier.
Okay, let's unpack this visual. So imagine a simple graph for us. The vertical y-axis, that tracks your reward.
Your expected annual return.
Right. And the horizontal x-axis, that's tracking risk. And in MPT, they measure that using something called standard deviation.
Mm-hmm. And for anyone who's not familiar, standard deviation is really just a technical way of talking about volatility.
How much things swing up and down.
That's all it is. How much the price of that investment is expected to swing. So a bigger swing means bigger risk. And when you plot every single possible combination of assets on this grid, you don't get a random cloud of dots.
No, you get a sharp, almost bullet-shaped curve.
That's right. And that curve exists because assets don't all move up and down together. They don't move in perfect sync.
Which is the whole point.
Yeah.
So tell us about the top edge of that bullet shape. That's the frontier, right?
That top boundary is the efficient frontier. If your portfolio sits right on that line, you are optimized. You are getting the absolute maximum possible return for that specific level of risk.
And if you're below the line,
then you're inefficient. You're taking on way too much risk, too much volatility for the return you're actually getting.
Okay, so what about above the line?
Well, that area is mathematically impossible. You can't get that level of return with that little risk. Unless, as our sources point out, you just ignore the math entirely, like Bernie Madoff and lying.
Right. So that makes the goal for you, listening to this, perfectly clear. We want to move your existing portfolio up and to the left on that chart.
Most people are inefficient. The portfolios are sitting way below that line, kind of trapped in that high-risk, medium-return zone.
And this is where that big blind spot shows up, isn't it?
It is. The optimization strategy isn't about just picking, better stocks by themselves. That's what everyone does by default.
The individual asset focus.
Right. The problem is when smart investors look at each thing and say, oh, Apple is a quality company or Tesla is a quality company, but they don't ask the most important question.
It is.
How do they interact when the market is crashing?
It's like trying to build a championship football team with 11 amazing quarterbacks.
Perfect analogy.
I mean, individually, they're all fantastic assets, but put them on a field together, and they're going to fail spectacularly against a decent defense.
Because there's no balance. You need assets that disagree with each other. You need some things that zig when other things zag. That's what lowers the volatility of the whole system.
MPT forces you to shift your focus away from just judging the quality of the individual parts.
And toward understanding how all those parts interact. You're maximizing returns by actively managing the volatility across the entire system.
So if even highly trained professionals and, brilliant analysts can have this blind spot looking only at the quality of each piece instead of the harmony of the whole system, it raises a pretty interesting question. What other areas of life or work might suffer from this exact same failure, this inability to look for the optimized system instead of just collecting excellent components? What stands out to you?
Okay, let's get into it. Today we're going to unpack a concept that's absolutely foundational if you want to get anywhere near that, that holy grail of investing, the efficient frontier.
It's the engine, really. The whole idea of getting the most return for the least risk, it all comes down to this one thing.
And that one thing is correlation.
Exactly. It sounds a bit academic, but it's really just a number. It goes from -1 to +1, and it just measures how two different assets move in relation to each other.
And to really make this stick, I think we have to start with that classic analogy, the island vendor.
Ah, yes, the perfect mental model. So imagine you're on an island. You have a business.
Two businesses, actually. Let's say asset A is sunglasses. When it's sunny, you're making a ton of money. When it rains,
We're making nothing, zero.
yeah,
And asset B is, of course, umbrellas.
the complete opposite. So if you only own one of those, your income is, well, it's all over the place, super volatile.
Huge peaks, deep valleys, high risk.
But, and this is the magic moment, what happens if you own 50% of the sunglasses business and 50% of the umbrella business?
Your income becomes perfectly smooth. Whether it's a heat wave or a monsoon, you are making steady money.
And that's the key takeaway for you listening. You haven't actually sacrificed your total expected profit. All you've done is smooth out the ride.
You've just massively, massively reduced your risk. And that, right there, is the entire point of diversification.
So that's the ideal scenario, the perfect -1 correlation. But let's break down the whole spectrum.
Right, because it's not always so perfect. You can think of it in 3 key points. First, you have a correlation of +1.0.
Perfect positive correlation.
Exactly. The assets move in perfect lockstep. Think of, say, 2 different big oil companies.
Yeah.
The price of oil drops, they both drop together.
So the diversification benefit is what?
0. Absolutely none. You haven't diversified, you've just doubled down on the same bet.
Okay, and then at the other end, you have our umbrellas and sunglasses, -1.0.
The Holy Grail. Perfect negative correlation. One goes up, the other goes down. That gives you the maximum possible risk reduction.
But what about the middle? What about 0?
Right, 0.0 correlation. And this is where it gets really interesting and, frankly, more realistic for building a portfolio. These are assets with no real relationship.
Like what?
The sources use the example of gold prices and Microsoft stock. There's no fundamental reason why the movement of one should dictate the movement of the other.
Wait, so if they're just moving randomly relative to each other, why is that so good? It doesn't seem as powerful as the perfect -1.
Because you're combining assets that both have positive expected returns, but their random movements tend to cancel each other out. You're getting a huge risk discount, almost for free. It's the sweet spot for portfolio construction.
That makes a lot of sense in theory, but this is where we run into what the source material calls the hard truth.
Yes, the hard truth.
All this beautiful math about diversification.
Yeah.
What happens when a real crisis hits?
It breaks. In a massive financial panic. Think 2008. Think the COVID crash in March 2020. Correlations do something terrifying. They all collapse towards +1.0.
Everything goes down together.
Everything. Because the driver is no longer fundamentals. It's panic. It's a system-wide demand for cash.
So people aren't just selling their bad assets.
They're selling everything. Stocks, bonds, gold, crypto. They're selling the winners and the losers because they need liquidity. It's like the island vendor suddenly having to sell both the umbrella and the sunglasses stand just because he needs cash right now.
Wow. So diversification fails you at the exact moment you need it the most.
It can. That's the fundamental challenge here. The theoretical benefit is massive, but the real-world panic factor can override the math entirely.
So as we wrap this up, the message for you is that understanding correlation is absolutely key.
But you also have to understand its limits. And maybe that's the final thought here. If correlation is the measure of how assets move, we also have to account for the psychological correlation of panic. It's this invisible force that grabs completely unrelated assets and pushes them all toward +1.0. That's the real monster the deep dive investor has to face.
Welcome to the deep dive. Today our mission is, well, it's to give you a real scorecard for telling skill apart from just pure luck in the financial world.
Which is the essential question.
Exactly. I mean, you see a fund manager with this spectacular return and you have to wonder, are they a genius? Or did they just ride a huge market wave? Okay, let's unpack this with an example. A fund manager boasts a, say, 20% return in 1 year. Sounds incredible.
On the surface, absolutely.
But what if the whole market, the S&P 500, our baseline went up 25% that same year?
Well, then that manager didn't just underperform. They actively lost you money compared to just buying a simple index fund.
Right. We need a much better way to measure that gap. And that's where 2 Greek letters come into play, beta and alpha.
And beta is really the starting point for all of this. It's the measure of market risk. You know how bouncy a stock or a whole portfolio is compared to that broad index.
It's the return you get just for showing up.
It's the return you get for taking the ride on the market wave, yes.
We found a great analogy for this. Think of beta as the type of car you're driving. So a beta of 1.0.
That's your standard family sedan. It moves exactly with the market. If the market is up 1%, your stock is up 1%. It mirrors it.
Yet then you have the extremes.
Exactly. A beta of 2.0. Now that's a sports car. It's twice as volatile. You'll get there faster when the road is clear.
But if the market crashes...
You crash twice as hard. And on the other end, you've got a low beta, maybe 0.5. That's your defensive minivan. Think utility companies or big retail stores.
So half as volatile, safer on those rough roads.
Much safer. So beta is just the return you get for the risk you choose to take in the market.
Okay, so that's beta. It's the risk we take on, but we pay these managers for their skill. We pay them to find alpha. What does that actually look like?
What's fascinating here is that alpha is everything else. It's the excess return, the part that's earned above what beta predicted.
So it's the pure skill.
It's the pure skill. It's that moment of insight, the manager seeing something that nobody else does.
But wait, if it's that hard to find, why are we even bothering to measure it? It feels like a way to justify really high fees for something that might not even be there.
That's the critical question, and it's why we measure it.
Yes.
We have to know if they're actually adding value. The simple calculation tells the story.
Okay.
Let's say the market is up 10%. Your portfolio has a beta of 1, so it should have returned 10%.
Right. It should have just matched the market.
Exactly. But if it actually returned 12%, that extra 2%, that's your alpha. That is the skill premium you paid for.
That sounds pretty clean on paper. What's the reality check, though? How often does that happen?
The reality is pretty sobering. The data we looked at is very clear on this.
Mm-hmm.
Finding true sustainable alpha is incredibly rare.
How rare?
So rare that most actively managed funds actually show a negative alpha once you factor in their fees and costs.
Wow. So you're not just underperforming. You are literally paying someone a fee to lose to the market for you.
Precisely. You're paying them a premium, sometimes 1.5%, 2%, for a fee structure that almost guarantees they'll fall behind a simple index. You're paying for market risk, that's beta, but the supposed skill you're paying for actually just drags you down.
So it's like paying for a racing stripe on that minivan, and the stripe actually makes it slower.
That's a perfect way to put it.
If we connect this to the bigger picture, then, this must be why passive investing has gotten so huge.
It's the entire reason. You see, beta is what you can get for almost free, just market exposure. Alpha is what you pay a premium for, that supposed managerial skill.
And passive investors are just saying, I'll take the beta.
They're saying, I'm happy with a beta of 1 and an alpha of 0. They're completely fine with 0 alpha because it means they also avoid the high fees that usually lead to negative alpha.
This really gives you a powerful new way to look at your investments. It's not just about the big return number anymore. It's all about the context behind it.
Mm-hmm.
Which leaves us, and you, with one final provocative thought. Since real alpha is so hard to find and fees so often guarantee a negative result, ask yourself this. When you look at where your money is going, how can you tell if you are paying for actual skill or just for some very expensive luck? That question should change how you read your next investment statement.
All right, so we're diving into your source material on fixed income, and our mission today is pretty clear. We want to pull out the operating manual for the bond market.
Yeah, for the financial bedrock that nobody really talks about.
The silent giant of global markets.
It absolutely is. If you think about a portfolio, stocks are the engine, right? That's the growth. But bonds are the airbag.
The airbag. I like that.
They're there to absorb shock, to prevent, a total catastrophe. And just to frame this, the global bond market is actually larger than the stock market.
Which is a fact that I think blows most people's minds. It really sets the stage for how important this is.
It's the infrastructure for everything else.
Okay, so to understand that infrastructure, you have to get one thing down. It's the single most important rule, and it's a little counterintuitive at first, the inverse relationship.
We call it the seesaw principle. It's actually pretty simple when you break it down. When interest rates out in the world go up, the price of your existing bond has to go down.
It's just math.
It's just math. It has to.
So let's run the numbers from the sources just to make it crystal clear. Say I bought a bond last year and it pays me 2%.
Okay, you're holding a 2% bond.
But then today, the Fed hikes rates and suddenly all the new bonds being issued are paying 5%.
Well, who would ever pay you full price for your little 2% bond now?
Nobody.
Exactly. To sell it, you have to put it on clearance. You have to drop that sticker price.
And that price drop is what makes the yield work out for the new buyer, getting them up to that 5% market rate.
That's it. The price has to move to compensate. So rates up, price down, the seesaw.
So if the price is all about where rates are, then the kind of bond you buy is obviously critical. Let's talk about the components. Your sources laid out three main categories.
Right, and we have to start with U.S. Treasuries. These are the safety baseline for the entire financial world.
Because they're backed by the U.S. government.
The ultimate IOU. When things get scary, this is where everyone runs. You've got short-term T-bills and then the longer T-notes and T-bonds for, locking up your money for decades.
Okay, so from maximum safety, we step onto the risk spectrum with corporate bonds.
And it's a wide open spectrum. You have rock-solid companies, that's investment-grade debt. Safe, but the yield is lower.
And then you have the other end.
The other end, high yield, or as most people call them, junk bonds.
Right.
These are from companies with shakier finances. To get you to take that risk of them defaulting, they have to pay you a much, much higher interest rate. Pure risk reward.
And then the third category is a bit unique. Municipal bonds or munis?
Munis, yeah, issued by cities, states, that sort of thing. And they have a superpower.
Which is?
The interest you earn is very often completely free from federal income tax.
So for certain investors, that's a huge deal.
For high-income earners, a slightly lower tax-free yield can easily beat a higher, fully taxed yield from a corporate bond. It's a game changer.
So this all brings us to the big picture. When we look at the rates for all these different durations, short-term versus long-term, what does that tell us? We have to talk about the yield curve.
Yes. Normally, the curve slopes up. We call it the normal curve. It's logical, right?
Yeah.
You should get paid more interest for locking your money up for 30 years than for 6 months.
You want to be paid for that long-term risk and uncertainty.
Of course. But the sources all point to this one terrifying scenario.
Yeah.
The inverted curve. When the whole thing flips upside down.
And that's when short-term bonds are suddenly paying more than long-term bonds.
Exactly. Think about what that means. It means investors are so profoundly worried about the next year or so, so worried that they will accept a lower payment just to lock their money away safely for 10 or 30 years. They're basically paying a premium to hide from the near future.
And here's the aha moment. This isn't just a theory. An inverted yield curve has predicted nearly every single recession in modern history.
It is the market's single loudest fire alarm. It says trouble is coming, and soon.
So to recap, bonds are the airbag, the seesaw rule is absolute, and the yield curve is the market's crystal ball.
That's the core of it.
So let's leave our listener with a final thought. If an inverted curve is a signal of near-term fear, what would a really steep, perfectly normal upward-sloping curve suggest? If it stays that way for a long time.
It would suggest massive confidence in long-term global stability.
Exactly. Not just for next year, but for 20 years from now. So the question is, if we were in that state of high confidence, what kind of shock, what kind of event would be big enough to break it all at once and flip that entire structure upside down? Something to watch for. Okay, so for today's deep dive, we're getting into a topic that's all about passive income. Real estate investment trusts. REITs.
And the material we dug into framed it with a line I just loved.
Oh, I know which one you mean. The landlord without the toilet repair.
Exactly. It immediately gets to the heart of the matter, doesn't it? You want the income from property, but nobody wants that 2 a.m. call about a leak.
No, absolutely not. So our mission here is to unpack how REITs let you do that, basically own property through the stock market. We'll hit three main things.
Right. The legal structure, liquidity, and how they handle inflation.
So let's start with the basics. A REIT is just a company that owns property that makes money. Think apartments, malls, that sort of thing. But what's the critical difference between a REIT and just some other company on the stock market?
It really boils down to a legal requirement, a regulatory rule.
Okay.
To even qualify as a REIT, and this is key, this is how they avoid paying corporate income tax. The law mandates they distribute at least 90% of their taxable income to shareholders.
90%. Not just revenue, but taxable income.
Precisely. So they are essentially forced by law to act as a pass-through for income directly to you.
And that forced payout, that completely changes the whole investment, doesn't it? They aren't hoarding cash for some future project.
Nope, they can't. They are legally obligated to send it your way as dividends, which is why you often see these REITs with, dividend yields that are way higher than the rest of the market.
Okay, so you have this high yield structure. But that income stream is only useful if you can get to it. And physical real estate is famously difficult to sell.
Oh, it's the definition of illiquid. Selling a building takes months. There's so much paperwork and the fees are huge.
Right. But with a REIT, you get that instant liquidity. It's traded just like a stock.
The convenience is just staggering. I mean, you can literally buy $50 worth of the Empire State Building on your phone in 2 seconds.
And sell it just as fast.
Yeah.
That mobility of capital is a massive advantage for the individual who wants that exposure without being trapped.
And that connects to the bigger economic picture, too. REITs are considered a real asset.
Meaning they're physical things, bricks and mortar.
Exactly. So when inflation kicks up, the cost to build a new building, the lumber, the concrete, all of it goes up. The value of the existing property rises.
But more importantly, the rents go up too, right?
That's the real key. Rents adjust upward with inflation.
Hold on, but our source material brought up a good point.
Yeah.
Doesn't the cost to borrow money also spike during inflation? Real estate is built on debt.
That's a great point, and it's a crucial distinction. Yes, rising interest rates make new deals more expensive.
Sure.
But the existing properties, the ones financed years ago with fixed-rate debt, their income stream is now rising while their biggest cost, the mortgage, stays flat.
So the cash flow actually improves.
It does. And that helps protect your purchasing power far better than just holding cash or, say, long-term bonds.
So the asset is this physical thing. But what we define as valuable real estate is changing so fast. I mean, 20 years ago, the sources said mall REITs were kings.
They were the absolute titans of the sector. Everything was about physical retail.
And now?
Now that's been completely flipped on its head. It mirrors the whole economy shift online.
So what are the new powerhouses?
We're talking about data center REITs, basically these giant secure warehouses that house the servers for the internet, and cell tower REITs.
It's kind of wild. The value used to be in the physical store where you bought a t-shirt. Now it's in the physical tower that delivers the Netflix stream to your phone.
It just shows you that real estate is simply the physical foundation for whatever the current economy is built on.
So let's bring it all home for you. What does this mean? You get high yields because of that 90% payout rule.
You get instant liquidity, which you'd never get with a physical building.
And you get a real hedge against inflation because rents rise.
And this whole shift, from malls to data centers, it really leaves you with a final question to think about. Well, what essential digital service today, maybe it's AI, maybe it's something at the blockchain, is going to need a brand new type of physical real asset foundation tomorrow? Because that's where the next big opportunity in this space is going to be. Welcome back to the deep dive. Today, we're getting physical. We're stepping away from the paper trail of stocks and bonds.
Right.
Our mission is to really get the difference between financial assets, promises on paper, and hard assets.
Which is quite literally stuff you can drop on your foot.
Exactly.
And that's not just a cute definition. The sources we looked at make it clear this is about understanding what they call the chaos hedge.
A chaos hedge.
Yeah. This isn't really about aggressive profit. It's insurance for survival. It's about assets that hold value outside the whole system.
For if or when that paper world fails.
That's the idea.
Okay, let's unpack this. We have to start with the king of hard assets, right? Gold.
Always.
What's so powerful is the duality of it. The case for gold seems so simple. It's been money for, 5,000 years?
5,000 years, yeah. And crucially, no central bank can just print more of it.
So it's the ultimate hedge against hyperinflation.
That's the case. But the argument against it is just as strong. I mean, it produces nothing.
Right. No cash flow, no dividends.
Minimal industrial use, really. You have Warren Buffett, who famously hates it. He had that great quote.
Oh, yeah. Just sits there looking at you.
Exactly.
So if Buffett's logic is that solid, what's the one statistical reason it stays in so many professional portfolios?
It's one word. Correlation.
Mm-hmm.
Or a lack of it.
Okay.
Gold is highly uncorrelated to stocks.
Okay.
So when the market crashes and everything is sinking, gold often zigs.
It's the insurance that pays out exactly when you need it most.
That is its entire job in a modern portfolio.
Okay, so that's gold, the fear gauge. But what about assets like oil, wheat, or copper? Are they telling a different story?
A completely different story. Gold is a lagging indicator. It reacts to fear that's already there.
Okay.
Industrial commodities are leading indicators. Their prices are just pure real-world supply and demand. They're cyclical.
And in that group, we kept seeing the name Dr. Copper.
Yeah.
That sounds like something out of a pulp novel. Why the PhD?
Well, because copper is in practically everything.
Houses, cars.
Your phone, It's essential for global construction, for
Yeah.
manufacturing. So if the price of copper suddenly starts crashing,
It means people have stopped building things.
it means the global economy is slowing down fast. It's a real-time health check on global demand.
So if someone listening decides they want this kind of protection, how do they actually get it? The sources outline two main ways.
Right.
The first, futures contracts. It sounds extremely dangerous for beginners.
It is. It's the pure way to play it, betting on next month's oil price. But you can lose your shirt very, very quickly.
So that really leaves the more common approach, commodity stocks.
Yep. You buy the producers, an ExxonMobil for energy, a Barrick Gold for gold.
And that's generally safer. Plus, these companies can pay dividends, right?
That's the big benefit, yeah. You can get paid to wait.
But wait, before anyone runs off to do that, we have to talk about the catch. There's a fundamental trade-off.
A huge one. It's called company risk. You have to remember what you're buying.
You're not just betting on the price of gold itself.
Not at all. Let's say gold rises 10%. Great. But what if the specific mining company you bought has a catastrophic mine collapse?
Or just terrible management.
Exactly. The commodity did what you wanted, but your stock goes to zero. You're exposed to business risk, not just the price.
Which brings us full circle. The big takeaway here seems to be that commodities are about protection, not necessarily profit.
It's a hedge against systemic failure.
So the final question for you listening is, what does this all mean for you?
And that raises, I think, a really provocative question, right, from the sources we looked at. If you are truly investing for a chaos hedge, where do you draw the line between a financial hedge and, well, physical necessity?
What do you mean by that?
I mean, do you really want gold ETF shares that are just numbers on a computer screen somewhere? Or are we talking about the extreme edge?
The actual canned beans and ammo.
That's it. That's the ultimate calculation you have to mull over when you think about true catastrophic insurance.
Welcome back to the deep dive. So today we're going to skip past the basic ingredients, the stocks, the bonds, and get right to the recipe itself, how you actually mix all those things together.
Exactly. And this isn't a small decision. The sources we dove into suggest this one choice determines a staggering 90% of your lifetime returns.
90%. Wow.
It's huge. And the key is understanding that there are really two distinct layers to this decision. And if you can get that difference, you can stop that frantic checking of the financial news every single day.
Okay, so let's get into it. The sources talk about two layers. We've got the map, and then we've got the detour.
Precisely. The map is your strategic asset allocation.
The long-term setting.
The long-term setting. It's your baseline, designed to last for decades, and it's based only on things like your age and your personal tolerance for risk.
So it's specifically designed to ignore the headlines.
Completely. And that's where its power comes from, that 90% figure. It's not from predicting the future. It's just from simple compounding consistency.
Okay, so if it's that important, what does one of these strategic maps actually look like?
Well, it dictates the big standards we all hear about. The classic one is the 60-40 portfolio.
60% stocks, 40% bonds.
Right. And then you have something more like the age rule, which suggests you hold your age as a percentage in bonds.
That age rule seems, I don't know, a bit conservative now, doesn't it? I mean, the sources mention a 20-year-old having an 80-20 split, which sounds right. But a 70-year-old with 70% in bonds, with lifespans getting longer, that feels like you're leaving a lot of growth on the table.
It's a very fair question, and the sources do acknowledge that tension. But you have to remember the goal of the strategic map. It prioritizes avoiding a catastrophic loss over squeezing out every last gain. It's about setting the guardrails.
Okay, so those are the guardrails. Let's talk about stepping outside of them, the detour.
Yeah.
This is tactical asset allocation.
Right. The tactical move is a short-term, intentional deviation from your baseline, and is based on what you perceive is happening in the market right now.
So let's use an example. My strategic map says 60% stocks, but I read the news and I think, uh-oh, the market's in a bubble.
Exactly. Your tactical move might be to say, okay, I'm shifting down to 50% stocks, 50% bonds, just to play defense for a while.
But that's just market timing. And that's notoriously risky.
It is. The real danger is what you miss if you're wrong. You might avoid a dip, but if the market keeps ripping higher, you've lost years of compounding.
A mistake that could be much worse than the dip itself.
Far worse. That's why the guideline from most advisors is to keep these tactical detours really modest. We're talking plus or minus 5, maybe 10% from your baseline.
A tweak, not a total overhaul.
It's a detour, not a new map.
So this sets up a fundamental conflict then. You have this disciplined, boring strategic plan on one side.
That's a so-called lazy portfolio.
Right. And on the other, you have this active, tactical genius who's always tweaking things. So is one lazy and the other smart.
Well, this is where the data is actually pretty humbling. The lazy portfolio, the one that just sticks to the map, it usually beats the active optimizer.
It wins. Why?
It's not because the tactical genius isn't smart enough. It's because the consistent, boring strategy is the best defense against the #1 portfolio killer.
Which is?
Yourself, your own emotions, panic selling in a crash, or buying into a bubble at the top.
So the rigid plan is really a safeguard against our own worst instincts.
That's it, exactly.
That distinction really clarifies so much. You have to know what your map is before you can even judge if a detour is worth the risk.
Right. And that really brings us to the final thought we want to leave you with. If this strategic allocation is so powerful because it forces you to ignore the noise and your own emotions, then the real question isn't just what's my asset mix, it's this. Given that emotional errors sabotage returns, what is the value of a financial strategy that actively requires you to ignore the daily headlines?
Welcome to the deep dive. Today we're getting into something that is just a critical lesson in managing your own financial risk. The idea of rebalancing.
Yeah.
And our sources all point to this core problem that it solves. It's this counterintuitive truth. Your gut tells you, let your winners run, right?
Mm-hmm.
But the actual math, the portfolio math, says you have to trim your winners just to manage your risk. It feels like a fight against your own human nature.
It absolutely is.
Yeah.
And the definition is so simple. Rebalancing is just the act of realigning the weights of your assets back to where you started.
Back to the original plan.
Exactly. The mission here isn't to predict the future. It's just to make sure you're taking the amount of risk you actually intended to take.
Okay, so let's unpack this mechanism. I think the classic 50-50 stocks and bonds example really illustrates it well.
Yeah, it's perfect.
So you start with a 50% stocks, 50% bonds portfolio. Let's say stocks have a great year, they go up 20%. And bonds, well, they just stay flat. The natural result is your portfolio has drifted. It's not 50-50 anymore. It's now, closer to 60% stocks and 40% bonds, just from that one good year.
And that drift, that seemingly small change, is where the danger lies. Your portfolio is now taking on way more risk than you signed up for.
And you didn't even do anything.
You did nothing. It happened passively. And the worst part is, this often happens right at the peak of a market cycle when things are most precarious.
So this is where the action comes in. To rebalance, to get back to that 50-50, you have to do something that feels very wrong.
Very wrong.
You have to sell some of those stocks that did so well, literally selling high, and then you have to BUY more of the boring bonds that did nothing, buying low.
And that's the magic of it right there. It forces a kind of discipline. It makes the investor do the hardest thing in the world.
Yeah.
Sell when everyone is euphoric and buy when everyone is, bored or even scared.
So it's basically a system for risk control. It's making sure that when that inevitable market crash comes, you haven't accidentally drifted into a super high-risk position right before the drop.
Exactly. You're not trying to maximize every last dollar of gain. You're trading some of that potential upside for the certainty of risk control. You're admitting you can't predict the future.
So if that discipline is the goal, how do you implement it? How often should you be doing this?
Well, the sources lay out two main methods here.
Okay.
The first one is called calendar rebalancing. Simple. You just pick a date, say every January 1st, and you rebalance no matter what happened.
Easy to stick to, I guess.
Very easy. But it's not always the most efficient. You might rebalance when you don't need to, or you might wait months after a huge market swing.
Which brings us to the other method.
Right, which is threshold rebalancing. This is a bit more dynamic. You only act when one of your asset classes drifts by a certain amount, like say 5%.
So if your stock's hit 55% of the portfolio, that's the trigger.
That's the trigger. You sell and buy to get back to 50. The research suggests this is often a bit better for truly managing risk because it's based on actual market volatility, not just a random date on a calendar.
So the big takeaway for you, the listener, seems to be that rebalancing is a tool. It's the tool that standardizes your risk and fights that powerful urge to chase gains.
It forces you to stick to your plan, not your feelings. And that leads to a really interesting final thought for you to consider.
Go on.
Well, if rebalancing is all about forced discipline and this kind of built-in skepticism about the market, what assumptions about future market performance must you be willing to completely abandon to actually do this effectively over the long term?
That is a critical question to think about. Thank you for bringing the sources to the table for this deep dive. We hope this helps you approach your own risk with a little more discipline.
All right, so if you're even thinking about investing, there's that. That one big fear, right? The one that just stops almost everyone.
Mm-hmm. That voice in your head.
Yeah, that voice that says, what if I put all my money in today and the market crashes tomorrow?
And that feeling, that anxiety, actually has a name in our source material. They call it timing risk.
Timing risk.
Exactly. And that risk is what leads to analysis paralysis.
Yeah.
You just get so stuck waiting for the perfect moment to invest that you never do.
You end up doing nothing at all, which is a huge weight, especially for new investors.
Mm-hmm.
So what's the cure? What does this reading say is the best way to get people off the sidelines?
It's a strategy called dollar cost averaging, or DCA for short.
DCA. Okay, let's unpack that.
Well, the premise is brilliantly simple, really. Instead of making one single huge investment, a lump sum, like say $12,000.
Dropping it all in at once.
Right. You don't do that. Instead, you commit to investing a smaller fixed amount over time. Maybe $1,000 every month for a year.
And you set it and forget it.
You set it and forget it. You do it on autopilot no matter what the price is doing.
Okay, that's where it gets interesting, I bet, especially in a volatile market. Let's run the numbers from the source.
Yeah, let's do it. So month one, you put in your first $1,000 and the price per share is $50.
Okay, so that gets you 20 shares. Simple enough.
Right. But then month two, the market. It hits a major speed bump. The price gets cut in half, down to $25.
Ouch. Okay, so that's the crash everyone fears.
That's the crash. But because you're on your automatic plan, that same $1,000 still goes in. Only now it buys you 40 shares.
Wow. Okay, so double the shares for the exact same amount of money.
Exactly. Then let's say in month three, things recover a bit. The price rallies to $40.
And your $1,000 buys 25 shares.
25 shares.
Wait a second. So over those 3 months, the market's average price was, around $38?
Yeah.
But because you bought way more when the price was low, your actual cost per share is...
It's lower than that, isn't it?
It's mathematically lower. And it's not a trick. It's just consistency.
How does that work?
Because you're investing a fixed dollar amount, you are automatically programmed to buy more shares when they're cheap and fewer shares when they're expensive.
It just forces your average cost per share down.
Precisely. It protects you from accidentally going all in at the top.
That's the mechanics of it, and the math is really compelling, but I feel like that's not the whole story. Where's the real power in this?
The real power is psychological. I mean, the math is great, but the mindset shift is everything.
Okay.
Without DCA, a market crash feels like a total disaster.
Yeah.
You see your portfolio in the red, you lose sleep, you panic.
Right. It feels personal, like you made a huge mistake.
Exactly. But with DCA, your mindset it flips. A crash is no longer a catastrophe.
It's a sale. It's a sale. It's a discount. You actually start to see a downturn as an opportunity because you know your next automatic deposit is coming up and it's going to scoop up shares on the cheap.
So it takes the emotion out of it. You're not trying to be a hero and time the market.
You're just being consistent. And that's the essential nuance here. The research is clear. Mathematically, over the long term, a lump sum investment usually wins.
Simply because markets tend to go up over time.
Right. But that mathematical superiority means nothing if fear keeps you on the sidelines in the first place.
So that's the catch. Psychologically, DCA is the clear winner because it actually gets people to start. It moves you from being a spectator to an investor.
It gets you in the game. That's the whole point. The focus is on action and consistency.
Which really brings us to the final thought we want to leave you with.
Yeah, it's a question for you to really think about. If the ultimate goal for long-term success is just consistency and action,
then which strategy is truly better for you? The one that's mathematically superior but might keep you paralyzed by fear? Or the one that's psychologically supportive and guarantees you'll actually take part? Okay, let's unpack this. We're doing a deep dive into financial options, calls, and puts, and we're using those FIN 401 source notes you sent over.
right?
The mission here is to really get our heads around what these things are, but also the fundamental risk transfer that's happening.
It's all about risk.
It is. And the core idea, the simplest way to think about it, is that an option is just a coupon. Let's use the Big Mac analogy. You have a coupon that gives you the right to buy a Big Mac for $2 anytime in the next 30 days.
Right. And if the Big Mac suddenly costs $5, that coupon is great.
Exactly. But if it only costs $1, your coupon is just caper. It's worthless paper.
And here's the crucial difference from a grocery coupon, and this is key. You have to pay cash right now for that financial coupon. It's called the premium.
So the premium isn't just the price of the paper. It's the cost of buying leverage, really.
It's the cost of opportunity.
Which brings us to the first contract type,
Yeah.
the call option. This is your classic bullish bet.
Your bet that the price is going up.
It's the right to BUY 100 shares at a specific price, the strike price, by a certain date.
Okay, so let's make that real.
Yeah, let's use the Apple example. Say Apple stock is trading at $150. You buy a call option with a $160 strike price.
So you're betting it'll go above 160.
You are. And let's say Apple just soars to $200. You get to exercise your right. You buy the shares at $160.
Even though they're worth 200 on the open market.
And you can immediately sell them for a $40 per share profit.
Well, a $40 gross profit, you have to subtract what you paid for that coupon, for the premium.
Good point. So your net is a little less. But here's the beautiful part for the buyer. If Apple stays flat or it drops,
The option just expires worthless. And you only lose that initial premium you paid. Your risk is totally capped.
totally capped.
Now let's pivot to the flip side. The put option.
The insurance policy.
That's the best way to think of it. It's the right to sell 100 shares at a specific price. You pay a small premium.
And if the market crashes, someone else has to buy your shares at that guaranteed price.
Yep. So let's use the protection example. You own Tesla at $200 a share, and you're nervous.
So you buy a put option with a $180 strike price.
What does that do? It guarantees you the right to sell your shares for $180, even if some disaster happens and Tesla crashes all the way to zero.
You've essentially put a floor under your investment. You've defined your absolute minimum selling price.
Exactly.
And this right here is where the distinction between the buyers and the sellers becomes so important. It's where beginners get wiped out.
Oh, absolutely.
The person buying the option, the one paying that premium,
Mm-hmm.
we can call them the long. They are the gambler in this analogy.
Limited loss, theoretically unlimited upside.
Yes,
Mhm.
that's the dream, right? The 1,000% return that gets everyone so excited.
And then you have the person selling that option. They're called the writer or the short. They are the casino.
They collect that sweet initial premium.
They do. They collect the cash up front, and they're just hoping that gambler's ticket expires worthless. But, and this is a huge but, they are taking on uncapped downside exposure.
That's the dynamic that is so dangerous. People focus only on collecting the premium, and they forget about the obligation. If the stock makes a massive move against them,
They have to pay up. The buyer exercises the contract called assignment, and the seller is on the hook. Their risk is theoretically unlimited.
which is terrifying.
It is. And because that risk is unlimited, the system requires the casino side, the seller, to post a lot of collateral. It's called margin.
Margin.
Yeah.
So they have to prove they can cover the loss.
They have to, and that margin is constantly adjusted to make sure they have the funds to pay out if the buyer hits the jackpot.
So the whole structure is defined by this.
Mm-hmm.
This incredible imbalance. The buyer pays a small fixed price for massive potential.
And the seller gets a small fixed payment in exchange for taking on potentially infinite liability.
So when we boil it all down, what does this all mean? The price of that coupon, the premium, it's a direct reflection of that huge risk imbalance, isn't it?
It is. You are literally paying a price to hand your risk over to the casino.
So that leads to a pretty interesting final thought.
Well, if the casino side, the sellers, are required to have all this massive, constantly adjusted collateral to cover that unlimited risk, it raises a question.
Which is?
How much of the options market's daily volume is driven, not by pure speculation, but by these large institutions just trying to manage and hedge their own margin requirements against their portfolios?
Okay, let's get into it. Today we're going to unpack a real financial puzzle.
Mm-hmm.
We're diving into options pricing.
Mm-hmm.
Specifically, the two fundamental parts that make up the price you see on the screen.
And understanding this is absolutely key. I mean, here's the paradox for you, right?
Yeah.
You buy a stock, it goes nowhere for a year. You haven't lost a thing. You buy an option, it goes nowhere. You probably lose everything.
Everything. Because options are, as they say, wasting assets.
Mm-hmm.
They have this built-in death clock, an expiration date.
Exactly. So that's our mission today. We're going to pull apart those two pieces of value. You've got intrinsic value, the real hard cash value.
And then the other part, extrinsic value, which is, well, it's basically what you pay for hope.
That's a great way to put it.
So let's start with the easy one, intrinsic value.
Right.
The simplest way I think about it is asking, if I cash this in, right this second, how much money would I get?
It's just simple, immediate math. Let's say a stock is at $100, and you hold a call option with a $90 strike price. Your intrinsic value is $10. Simple. You can buy at 90, sell at 100.
That $10 is locked in. It's real.
It's real, and it can never, ever be negative.
Okay, wait. So what if the stock is at 100, but my strike price is, say, 110? It's out of the money.
Right.
I can't exercise it for a profit, so is it just worthless then?
Its intrinsic value is zero, yes. Think of it like cash in your wallet. It can be empty, but it can't be negative.
Ah, I see.
But here's the million-dollar question. If that option has zero real value, why does the market still charge you maybe $2 to buy it?
And that's the gap, that $2.
Yeah.
That's the extrinsic value.
Exactly.
If the $10 from before was the guaranteed part, this extra $2 is what you pay for the chance the stock might go way up before it expires.
It is purely the price of two things, time and volatility. And since time is part of that price, it's also what kills it.
Which brings us to theta, time decay.
The big one.
And the rule here is just, it's brutal. That extrinsic value, that hope money, must go to zero by expiration. And it's not a straight line down.
No, not at all. It's exponential. We call it the death clock. It's not a steady tick.
Right.
When you're like 90 days out, the decay is pretty slow. You barely notice it.
But then you cross that 30-day mark.
It starts speeding up
Yeah.
a lot. And then once you hit that final week, the value just falls off a cliff.
So if you're an option buyer, time is your worst enemy. It's just eating away at that premium you paid.
Mm-hmm.
But what about that other part you mentioned? Volatility. Why would an option suddenly get incredibly expensive, even if the stock hasn't really moved?
This is where it gets really interesting. This is Ivy Crush.
Ivy Crush.
So imagine a big event is coming up. Earnings, maybe. The market price is in maximum chaos, maximum uncertainty.
Okay.
And that volatility just explodes. That $2 extrinsic value might suddenly jump to $10. That option is now ridiculously expensive.
Because everyone's paying for that lottery ticket.
Exactly. But the second that news comes out, certainty returns. And that uncertainty premium, it vanishes. Poof.
So even if you guess right and the stock goes up, you could still lose money.
You can lose a lot of money because of that extra value, that hope premium. It collapses faster than the stock can move to make up for it. It's the ultimate lesson in market psychology.
So what this all really means for you is that every single option price is just a combination of real value and hope value, 4V and EV.
And that hope value, the EV, is always in a losing fight against the clock.
Right. So here's a final thought to chew on. If we know that time decay gets exponentially faster in the last 7 days, I mean, what kind of strategies could you even develop that use that extreme risk and the potential for huge returns that's all packed into the final frantic week of an option's life?
It really makes you rethink your entire approach to time, doesn't it? Something to consider.
All right, welcome to the deep dive. So you sent over this material about options trading and specifically what our sources call the Greeks.
That's right. And they're not just, abstract terms. They're presented as a kind of critical dashboard.
A dashboard for a trader, like in an airplane cockpit.
Exactly. Think of it like an altimeter, a speedometer, and maybe a fear gauge, all in one. We're talking delta, theta, and vega. They tell you exactly how an options price is going to react.
Okay, let's unpack that. Let's start with the one that sounds like it's about movement. Delta.
Delta. So delta is how much an options price changes for every $1 move in the actual stock. It's on a scale from 0 to 1.0.
So if I have an option with a delta of, say, 0.50.
And the stock goes up $1, your options price goes up 50 cents.
Okay, simple enough. But if I want that dollar for dollar movement, why not just buy the stock? What's the hidden value here?
This is the really cool part. The secret use of delta. It's basically a quick and dirty way to see probability.
Probability?
Yeah. An option way out there with a delta of 0.10. You can look at that and think, okay, there's roughly a 10% chance this thing will actually finish profitably. It's a long shot.
I see. So it's not just a price metric, it's a risk assessment tool. Instantly tells you if you're holding a ticket for a likely winner or something else.
Precisely. So delta covers where you're going. But what about the cost of just standing still? That's where we get to the silent killer. Theta. It's the amount of value your option loses every single day just from time passing.
Yeah.
For a buyer, it's always, always negative.
And the sources frame this as rent, right? The daily rent you pay to hold the position.
It's the perfect analogy. You see a theta of nanid 0.05. That means your position is bleeding $5 per contract every
Right.
single day.
And that's a constant bleed. Where does it get worse?
Oh, it gets much worse. That's the trap. It's not linear at all. The decay accelerates like crazy as you get closer to the option's expiration date.
So you might lose a little in the first month, but a ton in the last week.
You could lose 50% in that final week. You have to be right, and you have to be right quickly, or theta will just eat your position alive.
Wow. Okay. So we have direction with delta and the cost of time with theta. That brings us to the last dial on the dashboard. Vega.
Vega. This one measures the option's sensitivity to volatility, to, fear.
Fear.
Yeah. I mean, what's so fascinating is that the stock price could stay completely flat, but if the market gets nervous, if volatility spikes, the price of your option goes up.
So Vega is like an anticipation gauge. It measures expected turbulence.
It does. And that means right before some big event, like a company's earnings report, options get really expensive. The sources call it crisis pricing.
Because everyone expects a big move, even if they don't know which way.
Exactly. And that's why you almost never want to buy options when Vega is super high. You're paying a huge premium for that uncertainty. The entry price is just punishing.
Okay, so let's pull this together then. Delta is direction. Theta is the tax of time. And Vega is panic.
Perfect. And to really lock it in, our sources gave us that brilliant taxi ride analogy.
Right. So delta is the distance you travel in the taxi.
Yeah.
It's how far you're moving toward your destination.
Mm-hmm. And theta is the meter that's running even when you're stuck in traffic. You're paying rent just for sitting there going nowhere.
In Vega.
Vega is the surge pricing. It suddenly starts raining and everyone wants a cab at once.
Right.
The trip itself hasn't changed, but the price to get in just shot through the roof because of the panic.
That really clarifies it. So mastering this dashboard is everything. But it leaves me with a final thought for you, the listener, to chew on.
Mm-hmm.
If Vega is the fear gauge,
Mm-hmm.
how do you, as an investor, distinguish between legitimate, necessary hedging against real risk and just simple, expensive panic that's driven by high volatility?
Yeah.
Something to think about.
Welcome to the Deep Dive. Today we're getting into a topic that most people tend to overlook, futures contracts.
Mm-hmm.
It's this huge global market that really sets the price for, well, almost everything, your coffee, the gas in your car. But the crazy thing, the paradox here, is that this market wasn't created to raise capital like the stock market.
Not at all.
It was created so people wouldn't starve.
And that origin story is everything. It tells you the original function was all about managing risk.
Yeah.
So our mission today is to really break that down, to unpack the ironclad legal obligation that defines futures and the incredible leverage that makes them so powerful and so dangerous.
Okay, so let's start with the classic analogy. You always hear about the farmer and the baker, right?
Right, the foundational story.
It's March. A farmer is planting wheat, and he's terrified that by harvest time in September, a huge supply glut will crash the price.
Meanwhile, you've got the baker who needs that wheat in September, and she's just as terrified that a drought will make the price skyrocket.
So they have opposite fears.
Exactly, so they shake on a deal.
Hmm.
Right now, in March, they agree to trade, say, 5,000 bushels in September at a fixed price. Let's call it $5 a bushel.
Okay.
That simple agreement completely eliminates the price risk for both of them. The farmer knows his revenue, the baker knows her cost.
Mm-hmm.
That's it. That's the reason this entire market was born.
What holds them to that deal? I mean, if the price of wheat shoots to $10, what stops the farmer from just walking away?
And that brings us to the core concept here.
Obligation.
Yes. It's not like an option where you have the right to buy or sell.
Right.
With the future, you must fulfill the contract.
That must fulfill is the legal anchor. It explains everything. Oh, it's true. Something like 99% of the people trading today are speculators. They have no intention of ever seeing a barrel of oil.
Right. They're just betting on the price.
Exactly. They get around that physical delivery by just closing out their position before the contract expires. But they're drawn to the market for one reason.
Unmatched leverage. To control, say, $100,000 of Apple stock, you might need to put up $50,000 in cash. That's 2-to-1 leverage.
Standards.
Very standard. But in futures, to control $100,000 worth of crude oil, the exchange might only require $5,000 in your account.
Wait, 5,000? That's what, 20-to-1 leverage?
20-to-1. And that is why it's so explosive. Because with that kind of leverage, if the price of oil just drops by 5%, which can happen in an afternoon,
A routine Tuesday.
a routine Tuesday, that 5% drop wipes out 100% of your cash. Your account's gone instantly.
And that idea of a non-negotiable physical obligation, It feels so abstract until you look at the ultimate real-world catastrophe. April 2020,
Oh, yeah.
when the price of crude oil didn't just crash, it went negative. It settled at minus $37. How was that even possible? How can a physical thing cost less than zero?
That was the moment where the abstract suddenly became brutally real for the speculators.
But-
They had failed to sell their contracts before they expired.
So the clock ran out.
The clock ran out. And they were now legally obligated to take physical delivery of millions of barrels of oil. But there was nowhere to put it. All the storage tanks in the world were full.
They literally had no place to store the oil they were forced to buy.
So that minus $37 price, that wasn't the value of the oil. That was the fee they had to pay someone, anyone, to please take the oil off their hands so they wouldn't default on the contract.
Wow. So the very rule designed to help the farmer is what completely destroyed the speculators. So what's the takeaway here for you? Futures are this vital tool for managing risk for the world's producers and consumers. But they have this extreme inherent leverage and this very real threat of physical obligation.
And it leaves you with this kind of nagging question, doesn't it? If 99% of the trading in this market is just pure speculation.
Just financial betting.
Yeah. What does that massive concentration of money do to the original crucial function of the market? For the actual farmer and the baker. Does all that speculation actually make it harder for them to discover a fair price or easier? That's the real tension at the heart of it all.
Welcome back to the Deep Dive. Today we're exploring one of the most counterintuitive ideas in all of finance.
Right.
Making a trade where you actually intend to lose money on it. At least if everything goes well.
It sounds strange, but it's really just paying for peace of mind. You're buying an insurance policy, and you hope you never, ever have to use it.
So our mission for this deep dive is to look at two big strategies for this and, really analyze the true cost of that insurance.
Okay, let's unpack this.
Let's jump right in with a scenario for an individual. Say you have $1 million portfolio, you're worried, maybe you see a crash coming.
But you can't sell.
Nah.
Maybe the tax implications would be huge.
Exactly. So you're kind of frozen, just sitting there, completely exposed to whatever the market does.
And this is where the solution comes in. It's called a protective put.
Her protective put.
Yeah, you buy something called put options on an index, like the S&P 500.
Yeah.
And a put option just gives you the right to sell at a set price later on.
So what does that actually do?
It immediately creates a concrete floor under your portfolio. Your losses are capped.
But that floor, that insurance, it's not free. It has a premium, right?
It does.
So say you spend, I don't know, $20,000 on that protection. What does the math actually look like?
Well, this is where it gets brilliant. Let's take two scenarios. Scenario A, the market rallies. It goes up 10%.
Okay, so my portfolio just made $100,000.
It did. And that $20,000 you spent on the puts, it expires worthless. You lost it.
So a net profit of $80,000. I can live with that.
You can definitely live with that. But now, scenario B. The real reason you bought the hedge?
The crash.
The market crashes hard.
Yeah.
Your portfolio loses $200,000. A disaster. But those puts you own, they explode in value. They might gain you $180,000.
Right, so the net loss is only $20,000.
Exactly. The cost of the premium. You paid $20,000 to completely avoid a $200,000 catastrophe. You lost far less, and you definitely slept well at night.
Okay, so shifting from an individual's anxiety to a huge corporate risk, let's talk about airlines.
Their biggest, most volatile cost is always jet fuel. If oil prices suddenly double, they could face bankruptcy. It's an existential threat.
So how do they hedge that?
They use something similar, often oil futures contracts. This just means they're locking in the price they'll pay for fuel, sometimes years in advance.
So if crude oil goes through the roof, they're losing money at the pump, but
they're making equal amount of money on their futures contracts. It completely offsets the extra cost.
And this is where it gets really interesting, right? The Southwest Airlines example from 2008.
Oh, that's the textbook case study.
Yeah.
In 2008, oil hit these historic highs. Almost every other major airline was just drowning in red ink.
But not Southwest.
Southwest was the only profitable one because they had been systematically, aggressively hedging for years before that. They'd locked in cheap oil prices 5 or 6 years before the spike even happened.
That is just undeniable financial security. But you mentioned there's a serious cost that gets overlooked. You called it the drag.
Yes, the drag. Think of it like a constant slow leak in your performance.
So those premiums, that $20,000 on the puts or the fees for the futures, that's the drag.
Precisely. They are constant costs that just chip away at your returns year after year, even when nothing bad happens.
Yeah.
If you're a disciplined, constant hedger, you are constantly paying this tax.
So what does that add up to?
Well, our sources show that if you maintain a continuous hedge on your portfolio, you are almost guaranteed to underperform the market by about 2, maybe 3% every single year.
So what does this all mean then?
It's a trade-off.
It seems like what we've seen is that hedging basically exchanges potential upside for guaranteed certainty. It puts that floor in for investors, and it shields these massive corporations from disaster.
And that really is the ultimate question for you, the listener. You know the cost now. It's that guaranteed 2 to 3% of annual underperformance. Is the peace of mind worth it? Is the ability to sleep well at night worth accepting that certain guaranteed lower return? So here's a fascinating question. How do you actually put a number on something as abstract as, market panic?
It's a huge puzzle. But back in 1993, the CBDCs, the Chicago Board Options Exchange, they actually tried to solve it.
And that's what created the VIX, right? The volatility index, everyone calls the fear gauge.
Exactly. And that's our mission for this deep dive. First, to really unpack how it works, which is surprisingly intuitive.
Okay.
But second, and this is really critical, we need to understand why the products you use to trade it have this major mathematical trap built right into them.
Okay, let's jump right on that. The VIX isn't based on stock prices.
No.
It's based on option prices.
Eee.
How does that even work? How does the price of a hedge measure how terrified the market is?
Well, the best way to think about it is insurance. It's all about insurance.
Insurance?
Yeah, specifically contracts called puts. They're what investors buy to protect themselves if the market suddenly crashes. So in a calm market, when everyone's feeling complacent, nobody's really buying much protection. Demand's low, so the insurance is cheap.
And a low price for insurance means the VIX is low.
That's it. We're talking below 15. That's the boring zone.
But hold on a second. If it's just measuring the price of this insurance, is it really measuring fear? Or is it just measuring wealthy investors buying protection? Is it skewed?
That's a great question. It's really measuring the cost of that fear. And that cost is, let's say, highly correlated with actual panic.
I see.
Because when real anxiety hits, investors don't just walk, they sprint to buy those puts.
And that demand spike sends the price of options through the roof.
Exactly. And that explosion in price is what sends the VIX soaring past 40. The index is tracking exactly how desperate people are for that insurance policy.
So we can actually use these as benchmarks. I mean, if I'm looking at our source material, a VIX below 15 is deep complacency.
Right.
And maybe 20 to 30, that's what, some nervousness?
Yeah.
A normal correction.
Yeah. The normal correction, yeah, exactly. But once you cross 40, you are in full-blown panic territory.
Like 2008.
Like 2008, or when the COVID lockdowns really hit the market in 2020, those are the moments that gave us that classic market rule.
When the VIX is high, it's time to buy. When the VIX is low, look out below.
You got it.
It always sounds a bit like a pirate shanty, doesn't it? But okay, here's the key. How do you actually trade this? And what's the big trap you mentioned?
This is where it gets really, really interesting. You can't just buy the VIX. It's an index.
Right.
You have to use products like an ETF called VXX, and this is where we have to issue the critical warning about the contango trap.
The contango trap. Okay, that sounds like serious jargon. Break that down. Why is it so dangerous if you just, hold on to it?
Well, the thing is, these funds, they don't actually hold the VIX. They hold VIX futures contracts. And because future volatility is almost always priced higher than today's volatility, that's contango, the fund is constantly selling the cheaper near-term contract to buy the more expensive longer-term one.
It's mathematically designed to lose money over time.
It is designed to bleed value. I mean, they're only for very short-term trades. A day, maybe a week. If you hold something like VXX for a whole year, a 90% loss is pretty standard.
90%. Wow. And this isn't just a theory, right? There was Volmageddon.
Oh, yeah. Volmageddon in 2018 is the perfect, terrifying example.
What happened there?
There was this fund, off 14. It was designed to do the opposite of the VIX, so you were betting on calmness.
A bet on things staying boring.
Exactly. And then one afternoon, the VIX had a massive spike. And that Axe Foyt fund, it went to zero. Wiped out.
How fast?
In about 45 minutes. Billions of dollars just gone. A terrifying lesson in what happens when you hold these decaying products.
So to tie this all together.
Look, the VIX is a brilliant tool. It's powerful. It's insightful. It measures real fear by looking at the price of insurance.
Right.
But the products you have to use to trade it have this this built-in risk, this mathematical decay that makes them incredibly toxic for the average long-term investor.
So what does this all mean for you? If the VIX is really a measure of market anxiety, based on what people will pay for protection, here's a thought to mull over. What non-financial indicator, maybe Google search trends or even social media sentiment, what do you think tracks its movements the closest?
Welcome to the deep dive. Today we're getting into a concept our sources call a few different things. The double-edged sword, for one.
And the speed multiplier. Both are perfect descriptions, really.
They really are. We're talking about leverage. And at its heart, it's pretty simple, isn't it? It's just borrowing money to try and amplify your results.
Exactly. But that amplification, that's where things get interesting and dangerous.
So let's set the stage. The classic example is always real estate, right? It's intuitive.
It is. So let's say you buy a house, $500,000, and you pay all cash.
Okay, no loan.
No loan. The market has a good year. The house value goes up 10%. You've made 10% on your money. Simple.
$50,000 profit on a $500,000 investment. Makes sense.
But now let's use leverage. Same house, but you only put down $50,000. So that's a, 10-to-1 leverage?
Right. You borrow the other $450,000.
Exactly. Now, the asset, the house still goes up by that same 10%. That's still a $50,000 gain in value.
But you only put in $50,000, so you've doubled your money.
You've made a 100% return. That's the speed multiplier.
But here comes the other edge of that sword.
Here it comes. Because if that $500,000 asset drops by 10%,
your $50,000 is just gone, wiped out completely.
100% of your equity vanished. And in the stock market, this all happens much, much faster.
Right, because you're not dealing with houses, you're dealing with a margin loan from a broker.
And the key concept there is the maintenance margin. The broker says, look, a certain percentage of the account's value has to be your own money. Usually it's around 25%.
And that's not a friendly suggestion. This is the broker's safety net, not yours. If you fall below that line...
They don't call you. They don't ask nicely. An algorithm just sells your stuff. It liquidates your positions instantly to get their money back.
Which can create this horrifying cascade effect, the death spiral.
That's it. Because a breaker having to dump millions of dollars of a stock forces the price down.
Which then triggers someone else's margin call.
And then they are forced to sell, which pushes the price down even more. It feeds on itself.
It's a chain reaction. Okay, so with a normal margin loan, you can only lose what you put in. But there's a way to lose, everything. And more.
Infinite losses.
Short selling.
Yeah. With short selling, you're borrowing shares to sell them, betting the price will go down so you can buy them back cheaper.
But if you're wrong, if the price goes up...
There's no limit to how high a stock price can go, which means there is no limit to your potential loss. You still have to buy those shares back eventually.
And we all saw this play out with GameStop, GME.
The perfect example. Hedge funds had massive short positions. They were betting it would go down.
But a huge number of retail investors started buying, pushing the price up from $4 to...
It went to over $400 at its peak. So the hedge funds got margin call, but to close their short position, they had to buy the stock.
So their forced buying just threw gasoline on the fire?
It created a massive feedback loop. Their buying pushed the price higher, which triggered more margin calls, which forced more buying. Billions and billions of dollars in losses.
It's brutal.
Yeah.
Which I think connects to the psychology of all this. You found that great story about Archie Carrot?
Oh, yeah. The ultimate example. He leveraged $50 into $40 million playing craps and poker. An unbelievable run.
$40 million.
But he never took his foot off the gas. He kept the same extreme risk level, and he lost all $40 million in 3 weeks.
So what's the takeaway here for you listening? It seems like leverage is this incredible tool for winning fast.
It is. But the cost is that you completely remove your ability to survive bad luck. Or even just one bad decision. You can be right 9 times out of 10, but that one time can be extinction.
So it's not just a financial tool. It's a force you have to respect.
Absolutely. And that raises the final question, I think. When you use leverage, you have to understand the fundamental shift in the game you're playing. You're no longer just playing to win. You're playing not to lose everything on a single roll of the dice. And that's the difference between amplification and, extinction. Welcome to the Deep Dive. Today, we're tearing into Nassim Taleb's The Black Swan. It's a book that really just fundamentally changes how you see risk, data, and, most predictions are probably worthless.
That's exactly right. Our mission today is a focused one. We want to understand why traditional systems, especially in finance, fail so catastrophically.
Because they just can't account for that one rare event.
Precisely. And then we'll get into what Taleb suggests we can do about it, how to build systems that might actually thrive when chaos hits.
Okay, let's just get right into it with the single most famous idea in the book, the turkey problem. So imagine a turkey. For 1,000 straight days, a farmer feeds it, cares for it. Every single data point the turkey gathers confirms the farmer is its best friend.
The evidence is overwhelming. Based on that data, the turkey's risk model says the probability of anything bad happening is, statistically zero.
It is a mountain of proof. And then comes day 1001. Exactly. That single event, the black swan, it's completely unpredictable from the turkey's point of view, and it invalidates all the previous data instantly.
And this is the fatal mistakes that so many financial models make. I mean, traditional finance is built on the normal distribution, the bell curve.
Right, the thing we all learned in stats class.
Yeah. And that model assumes extreme events, like a massive market crash, are so rare they should only happen, like, once every billion years.
But that's not what we see in reality. Not at all. The real world, especially financial markets, has what Taleb calls fat tails.
Meaning those extreme events are way, way more likely than the bell curve suggests.
I mean, just look at the last few decades. We've had 1987, the dot-com bust, in 2000, 2008, 2020. These aren't once-in-a-billion-year events.
It's like building a bridge assuming the wind will never exceed 50 miles per hour because that's the average.
Yeah, but, a 100-mile-per-hour hurricane hits the coast every 10 years.
Exactly. Your model feels safe, but reality has a hurricane waiting in the wings.
And this flawed math, it leads directly to these risk management tools banks use, like value at risk or VAR.
Oh, VAR, at the ultimate false comfort.
They give you this very reassuring statement, something like, we are 99% confident we won't lose more than $10 million tomorrow.
And the killer flaw is right there in what they're not saying. It's all about that 1% they brush aside.
Because in that 1% scenario, it's not that they lose 11 million.
No, they lose 10 billion. It's a complete wipeout. VAR is great at measuring the small, everyday bumps, but it is completely blind to the one event that destroys the entire bank.
So if prediction is useless and our tools are blind, what do? Just hide in a bunker with gold bars?
Not at all. This is where Taleb's big idea comes in. You have to stop trying to be robust, which just means you can take a punch. You need to be anti-fragile.
Anti-fragile? Meaning what, exactly?
Meaning you actually get stronger from stress and chaos. Think of human muscles. Without stress, without lifting weights, they get weaker. They need that volatility.
Okay, so there are three states. You have fragile, which hates chaos.
Like a bank loaded with debt.
Then robust, which just resists it.
Think of gold or cash. It survives, but it doesn't gain.
And then anti-fragile, which actually loves the disorder. It feeds on it.
And that brings us to the most practical takeaway for you, the barbell strategy.
Right. And this is where it gets really counterintuitive.
It does. The strategy says you should actively avoid the middle, all those moderately risky diversified funds.
Wait, avoid diversification. That's the opposite of what everyone is taught.
I know. But in a world with fat tails, that middle ground gives you mediocre returns while still leaving you completely exposed to that black swan event that wipes you out.
So the barbell is,
yeah,
you go to the extremes instead.
Exactly. You put, say, 90% of your assets in something incredibly safe. Treasury bonds, cash, something that cannot be destroyed. That's one end of the barbell.
The robust end.
The robust end. And then you take the other 10% and put it into extremely risky, high-reward bets. Venture capital, speculative options, things that benefit from massive volatility.
So you're protected from ruin by the 90%, but you have huge upside potential from the 10% if chaos hits.
That's the idea. The goal isn't to predict the future. It's impossible. The goal is to set yourself up so that when the unpredictable crash happens, it doesn't kill you. It might even help you.
You're not trying to see the black swan coming. You're just making sure it can't eat you when it lands.
Which leaves a pretty big question for you to think about. If this is how unreliable our data is for finance, what other parts of your life are you basing on 1,000 days of good weather, your career, your projects? Where is your Thanksgiving Day event just waiting to happen?